So that is number 3, Modigliani and Miller. This one is always examined, and it is one of the basic formulas that you need to understand as far as advanced FM is concerned. And the formulas that we are now picking going forward, those formulas are quite a number of them. There are quite a number of them. And you need to understand them as you tackle FM questions. In other words, nakwambia kwamba inafaa ushike hizo formulas ndio uweze kufanya FM vizuri. Sawa sawa. So thank you, Winnie, for joining. So we're looking at Modigliani and Miller proposition. So the first proposition is called MM1. That is the proposition 1. MM1. MM1 means the world without tax, a world without corporate tax. World without corporate tax. This one is similar to which one? From the example that we did, or from other theories that we have done, which one was also the same as this, that talks about a world without corporate tax? It is assuming that the market doesn't have corporate taxes, the world without corporate taxes. That means that corporate tax is 0. Corporate tax is 0. It is the same as no, eh? Okay, so that's true. So we are saying that Modigliani proposition 1, which we call MM1, that is M and M, so it is MM1, refers to a situation where in the market there are no taxation. There is no government influence on the prices or the value of assets or securities. So you can be able to value a company without considering taxes. That is a world without tax. If you have a question, please go ahead. How far have you gone? We are just starting. This is the first thing. When I told you welcome, we are just starting. Shady, I'm happy that I can see people joining. Thank you so much, Ken, for coming. Thank you so much, Shady. If this is number 3, where is number 1 and 2? Number 1 and 2 we have done. The first one was called net operating income approach, that is NI. Then number 2 was NOI. That is net income approach and net operating income approach. So we have done 1 and 2. This one is number 3. Those are theories when. So you are not in that day that you are missing your book. You remember that day, Waziri? Wakati ulikuwa unajiuliza whether niacha kitabu kwa gari, sijui ulikuwa huko nje. That is the day we did this, Mimi nakumbuka. Thank you. So we are saying that these are theories you don't remember. Is there anybody who can remember the day Waziri alikuwa anasema ati akumbuki mahali anaacha vitabu? Who can remember? These are theories of capital structures, and the first one was net income approach. We have net operating income approach. That is the second one. The third one is called Modigliani and Miller proposition. And we are saying that under Modigliani and Miller proposition, ile day ulikuwa wedding mama. Okay, so umekumbuka hiyo siku. Thank you for reminding her. Now, we are saying that the first one is called the first proposition, which is the corporate tax 0. You can write under this. I want you to write that the first proposition, sorry for those who are joining today, we are in topic number 3. In topic number 3, that is advanced financing decision. Advanced financing decision is about how you can be able to make a decision on the sources of capital. You want to get capital whose source is actually cheap. You want to ensure that the cost of capital is cheap. So in that particular topic, we are also looking at how do you value a company so that when you're buying the company, you know the price and the value of that company. Now, what we're looking at today are some of the theories that have been brought forward by different people or scholars, where they're trying to look at different ways of valuing a company. So Modigliani and Miller are some of the scholars who have proposed different ways or theories, which we call propositions, that you can use to value the company. So the first proposal, there are four. The first one is called a world without taxes. They are assuming that they can value a company in a situation where in that country or the economy or the market, there are no taxes that are applicable. So you can write that the first proposition states that the first proposition states that the capital structure decisions are irrelevant. The first proposition states that the capital structures are irrelevant. The capital structure decisions are irrelevant, meaning that it doesn't matter the structure that you're using. The structure that you're using doesn't matter. So I can see, Winnie, you are the first proposition states that the capital structure decisions are irrelevant, i.e., value of unlevered farm equals value of levered farm. The value of unlevered farm is equal to value of levered farm. So what MM1 proposes that doesn't matter the structure of the business. Remember, the structure of the company that we're talking about is where you are having a certain percentage of debt plus a certain percentage of equity. What again is saying that it doesn't matter whether the company is fully financed by equity or has both equity and debt. The structure doesn't affect the value of the company. The structure doesn't affect the value of the company. So we are saying that the first proposition states that the company structure decisions are irrelevant, i.e., value of unlevered farm equals value of levered farm. Yes, irrelevant, doesn't matter, irrelevant, haina impact. The value of unlevered farm equals value of levered farm. The value of unlevered farm equals the value of levered farm. The value of unlevered farm equals the value of levered farm. That means, so you say that i.e., value of unlevered farm is equal to value of levered farm. So VU is equal to VL. That is the first proposition. And we are saying that MM1 is equal to NOI, where we are saying that world without taxes. That is an economy where taxes do not apply. World without taxes. World without taxes. So VU is equal to VL. MM1 is the same as NOI, that is a world without taxes. That is what MM1 means. So that means that it is applicable just the same way as NOI. Let's go to MM2. That was MM1, which is here. Proposition 1. Then now MM2. MM2 is called a world of corporate taxes. This one means, that is MM2. It is again the same as Modigliani proposition 2. This is Modigliani and Miller proposition 1. This one is Modigliani and Miller proposition 2. This one says that the world has got taxes, the economy has got taxes. So we have to look at the implication of tax on the value of company. You can say that with the taxes, comma, with the taxes, comma, with the taxes, comma, value of levered farm is always higher than value of unlevered farm. With the taxes, comma, with the taxes, comma, value of levered farm is always higher than the value of unlevered farm. So VL is always higher than VU, where there are taxes. Therefore, we have these two formulas. You can call them A and B. We are saying that VL is equal to VU plus now depreciation tax share. Remember the first formula. The first formula we were saying that VL is equal to VU, right? But we are saying that if we have tax, then there is advantage that we have. If we have tax, there are advantages that we get through that taxation. We are always exempted. We are going to exempt depreciation from taxation. So that is an advantage. That tax shield makes VL more than VU. That is why now VL is equal to VU plus the depreciation tax shield. And how do we get this one? We get it because the taxes now apply. So there is advantage by not taxing the depreciation. So that is proposition 2. Says that when there are taxes, then now VL is higher than VU by the benefit of depreciation tax shield that we are going to add. So that is the formula that we're going to have, that now we have depreciation tax shield, and you know how it looks like. Another formula that we also have under this MM2 is that the cost of levered farm, the cost of equity of levered farm, that is KEL, the cost of equity of unlevered farm, KEL, is equal to KE, that is the cost of equity of unlevered farm. Listen again. Cost of equity of levered farm is equal to cost of equity of unlevered farm plus, into bracket, the cost of equity of unlevered farm minus cost of debt, into bracket, you close the bracket, debt over equity, that is debt to equity ratio, into 1 minus T. That is another formula of getting the cost of equity of a levered farm. So this MM2 is giving us two serious formulas that you should never forget before you finish your CPA. Before you do your FM, you always need to remember this formula. There are two formulas that we're given. There are two formulas that we're getting from MM proposition 2. The first formula helps us to get the value of the farm. The second formula is for getting the cost of equity of a levered farm. And the cost of equity of a levered farm is equal to the cost of equity of a levered farm plus the cost of equity of a levered farm minus cost of debt into debt equity ratio. Debt to equity ratio into 1 minus T. You remember the first formula that we were using? Initially, in our previous class, we had a different formula of getting the KE, all right? We were saying that KE, in the other example, we said that KE was the earning after tax all over the value of equity, all right? We learned about something like that, still. Now, this is another formula of getting KE. The first one we learned, this is the second formula that you need to remember. I hope that you've written that so that you can do illustration. Let's look at illustration. So in MM2, we have two serious formulas that you need to remember. So in exams, when you are calculating the KE, in exam, when you are calculating the KE, you will look at the question itself and ask yourself, what kind of information am I given? Are you given the information where you have the value of equity and the earnings, or you have information where you're given the debt equity ratio and the cost of a levered farm and cost of debt? If you are only given this information, you can still get KE error. So let's look at illustration. You can call it illustration 1. Call it illustration 1. We have levered farm, which we call L, and then we have unlevered farm, we call U. Now you know that, right? And then we have EBIT. Then we have the EBIT is 1 million, right? EBIT is basically earning before interest and tax. Earning before interest and tax, that is 1 million. So we also have the other side 1 million. So we are comparing two companies. One company is levered, meaning that it has got the debt elements, or we call it geared farm. And then we have ungeared or unlevered farm. This one is fully financed by equity. It does not have debt at all. But we are assuming that in terms of the performance, both of them made the same profit. Both of them have the same profit. And then now we have cost of equity that is given. Here it is 10%. And then we also have 10% here. Right? Then we have the tax rates. So tax rate in percentage, we have 30%. We have 30%. Right? Then we have the debt. So we have 8% debt. And of course, debt has to be on the levered farm, and levered does not have debt. So the debt is here. The amount of debt is 5 million. On this other side, we don't have debt. So we are having these two companies that we need to check their value or compare their value. You can say required. Required. Calculate the value of each farm. Calculate the value of each farm. And work. Calculate the value of each farm and work. Work means weighted average cost of capital. So you need to calculate the value of the farm and work. We want to compare the value of levered farm and the value of unlevered farm. Also the cost of levered farm and the weighted average cost of unlevered farm. And then you can be able to see which one is better for you. So are we together there? Can we proceed? Fine. So I'll wrap this. I hope that you have written them down. I can see Mary has a problem with the network. Kindly take a screenshot. You can take a screenshot so that we proceed. So in proposition 2, how do we know that we need to apply proposition 2 in this question? There are things that shows that we need to apply proposition 2. Number 1, we have been given tax. That means that this world has got taxes. The economy in this question, there are taxes. Yes, thank you so much, Willie. So that means that you can't apply proposition 1. Proposition 1 was assuming there are no taxes. So whenever you're given taxes, you need to think about applying proposition 2. So let's now calculate the value. So what we are having here, in proportion 2, when we have taxes, the value of levered farm, we say that is the same as the value of unlevered farm plus depreciation tax shield. We can get this one. So let's calculate the VU. So VU, what did we say? VU does not have debt. VU does not have debt. So what do we do? We use the formula that we have. We are assuming that this one is fully financed by equity, and the formula was EBIT minus interest into 1 minus T, right? All over the value of, all over, this is value of unlevered farm. So it is all over KE. KE of unlevered farm. Then we can now proceed and have our EBIT, which is 1 million. In unlevered farm, do we have debt? In unlevered farm, there is no debt. So therefore, here, there is no interest on debt. So interest on debt is 0. And of course, if it is 0, then even if you multiply it with the tax, it is still 0. So we are going to have this all over KEU. What do we have? The cost of equity under unlevered farm. Cost of equity of unlevered farm is cost of equity of unlevered farm is 10%, which is 0.1. So here we have 1 minus T. So we are going to have 1 million minus 0, that is just 1 million. 1 minus T, tax we are given as 30%. So 1 minus T is 0.70. So we are going to have here 1 million times 0.7 or into 0.7 all over 0.1, where we are going to have 7 million. This one is basically the earning before interest and tax. So we don't have interest, interest is 0. So we only minus tax. You only minus tax. And that is why we multiply the whole thing with tax. The only thing that we don't have is interest, because the company is unlevered, does not have debt. So you cannot get interest where there is no debt. But tax, we can subtract. So that is what you're going to get as the value of unlevered farm. Somebody is saying that, kindly pardon, how do we arrive at the formula? The formula was given up here. That is the formula for MM2. MM2. We had 2 formulas for MM2. And in MM2, we are saying that the value of levered farm is always assumed to be higher than the value of unlevered farm by the fact that there is a depreciation tax shield. Any other question? Is it? It is. Ile hesabu tumezoea ni VU ingekuwa equal to VD and debt tax shield, not depreciation but debt tax shield. Not debt, not depreciation but debt. You see now when you are going to pay, whenever you are paying interest on debt, you normally subtract the interest before you tax the balance. Let me just explain this. Normally we have an earning before interest and tax. let's say it is 1,000. Then the next thing, you first subtract less interest. You less interest before you tax. So let's say interest is 200. The balance that you're going to have here is 8. It means that because of the presence of debt, you are going to exempt this interest from taxation. So kuna hii amount that you're going to exempt from tax, that is an advantage. So that is why we are saying that whenever you are having a debt, like in VL, what will live farm, there is an advantage that you get as a result of that debt. And that is why there is B here. Not debt, not inflation, but debt. It is an advantage that you get. So you are going to escape tax because of that process of debt. You are not going to tax this particular interest. You only tax the balance after interest, this one. So already we have calculated our VU, which we got to be 7 million. You can unmute. Okay, let me unmute somebody here.
Asante, nasema ukiangalia from the initial equation hapo juu VL equals to VU, hii hapa VL naosema hii question ya equation hiyo VL equals to VU plus DT, hiyo umeandika tu hapo. So what I'm plus DT vile umeandika hiyo hapo. So what I'm saying, if you want VU hapo chini sasa hizo interest before tax, earnings before nini, I was expecting mimi VU will be equals to VL minus DT. That's the question.
Now we are looking for VL. Hiyo VL ya tujui. So you cannot say VU is VL minus, because that here VU is unknown. So you need to now get this and also get this, then you add it to get VL. VL is the value of livered farm. Hatujui, and we want to know it. So you need to know this plus this. And I've explained that this one you can calculate using this formula. We have VU where there is no debt. So if there is no debt, even interest is 0. So it is 1 million minus 0. It is going to be 1 million times the tax. You're going to have 7M. And then you are saying, whenever you bring debt as part of your financing, kuna ile benefit unapata kwamba the interest that you're going to generate from that debt is normally tax allowable. You first have earning before interest and tax. So you less interest, which is this, and then you now tax the balance. So because of that, we have a tax shield. Just like the way we are having depreciation tax shield, you are allowing depreciation. Here, interest is also allowable. So because of the presence of that debt, you now have debt times the value of tax. That is what D means. So that we are going to calculate here. That is what the formula has. So we can be able to get our DT, where DT is equal to, our debt was 5M times 0 point, tax ni ngapi? 30%. So we're going to have 1.5M, right? So we have our VU, we have our DT. Therefore, VL is equal to, VL is equal to now 7, which is VU, plus 1.5, which is 8.5 M. Thank you. So that is how that formula works. So you need to calculate this separately, then you add them, then you get your VL. So that is the value of
it is 8.5.
The value of livered farm.
8.5, not 80.
Somebody has a question? Wait.
It is 8.5, not 85.
Come again?
The value of the VL is 8.5. Now I'm seeing you've written 85.
Kuna dot hapa. Hii ni dot. Inaonekana sasa. Sawa. So let's proceed. So we have the value of a livered farm, which we have calculated. It is 7. The value of livered farm is 8.5. The question was to calculate the value of the two farms. The first farm we have calculated by default, which is unlivered, and then now livered. So to solve these two farms, we have seen. Now you can see from there that VL is 8.5 when VU is 7M. Read what we wrote earlier. We said that with taxes, value of livered farm is always higher than value of unlivered farm. When you have taxes, value of livered farm is always higher than value of unlivered farm. Let's now proceed to calculate our work. How do we calculate work? Formula for calculating work. We are told to calculate work for the farms, the two farms. For unlivered farm, work of unlivered farm is the same as the cost of equity of unlivered farm. Is there any person who has a challenge that? Sinakwanga hivyo. So what we're going to calculate now is the one for livered farm. Hapo ndio kuna shida because we have to wait. We have to weigh them. So for livered farm, work is equal to the weight of equity times the cost of equity plus weight of debt times the cost of debt into 1 minus T. That is the formula. Now we need to know, do we have weight of equity? How do you get weight of equity? Somebody can just talk. Weight of equity. Somebody tell us, how do you get the weight of equity? We get equity debt ratio. Equity debt ratio is this one. Equity debt ratio, it is equity all over debt. Weight, yes. Ruth, you are right. It is the proportion of equity on the value of livered farm. So you need to know what was the equity and what is the value of livered farm. The same with weight of debt. You need to know debt all over the value of livered farm. Because previously we learned that the value of livered farm is the same as equity plus debt. So meaning that these two makes this. So the proportion of equity on this of the total and proportion of debt on the total. So what is the proportion of equity? Do we know the value of equity? If VL is equal to equity plus debt, then it means that equity is equal to what? VL minus debt. And do we know VL? We have calculated VL to be 8.5, senior value of livered farm. And debt we are given us 5 million. So it means that our E is 3.5 million. Tumeona? Are we together there? That is how you get the value of equity. In the information, we know the value of debt was 5 million. The value of levered farm we have calculated to be 8.5. Therefore, you simply subtract, then you get your 3.5. Tuko sawa hapo? Okay, so I can proceed and say that now our BE, our weight of equity, is equal to 3.5 all over 8.5. When we have weight of debt being equal to 5 all over 8.5. So get me the weights. Get me the weights. Get me the weights. What are the weights? Equity 0.41. And debt, weight of debt is 0.59. Thank you. From this formula, we now have the weights for each. What we want to look at is now the cost of equity and the cost of debt. Now we say that there are formulas of calculating the cost of equity. One of the ways of calculating the cost of equity was the cost of equity. We say that KE of a levered farm is equal to EBIT minus interest into 1 minus tax all over the value of equity. That was one of the formulas. That was one of the formulas. Unakumbuka? Can we try using that and see the value of the cost of equity? Kwanza, do we remember this formula? That's what we learned earlier in our previous lessons. Remember, these formulas are not contradicting each other. They are just giving complementary. They are just adjusting. So do we remember this formula when we started in our previous class? Winnie, nakumbuka hii? That is what I said, earning after tax. When I was saying that this one is equal to earning after tax all over BE, the same as this is earning after interest and tax. Do you remember that? Adjust volume. You don't get me. Can somebody hear me? Tunakumbuka hii formula ya kupata KE. Let me check where we learned that. You don't have to forget about this. Net income approach. Net income approach was saying that it is the value of equity is profit after tax all over cost of equity. Profit after tax all over cost of equity. Net income approach. Ilikuwa nasema that the value, which is this one, VE, is equal to profit after tax, which is this one, all over the cost of equity. So that means that cost of equity, you can substitute and say that now cost of equity is equal to profit after tax all over value of equity. Are they not the same thing? In NI, net operating income. The only difference here is that in this one, we now expand it and there is debt in it. Probably in NI there were no debts, there were no tax. This one now has tax, but the formula is the same. There were no taxes here, but now here there are taxes. The formula remains the same. You only remove that tax. You only deduct that tax. The rest remain. So if that is the case, this one and this one are basically the same things, then we can calculate our KEL using this formula. Why? Because at least we have all this information that can help us. Tuko na hizi information. Wakati hatuna, tunaweza acha kutumia hii formula. Where do we apply the second formula? The second formula that we allow today, we are going to try it and see if all of them are, if they are the same. We are going to try that. Sasa win. But kwa mtihani inadependa zile information umepewa. What is available for you to use? You check the question. Do you have this information? If you have this, you can use this KEL. But then the second formula that we will learn today, we shall also apply and see. If you don't have this, you apply the second formula. They should be able to help you get what you want. Now that kuna the third one, to learn the third one as well. Ama, did we learn? Yes, we had learned the third one. The third one was, you remember when we were saying that P is equal to D? See, we learned something like this. So it means that we can substitute this. We can now say that KE is equal to DO over P naught plus D. So we have three formulas of calculating KE. Kuna hii ya kitambo, which we learned earlier, hii ya juzi, na ya leo. Those are three formulas of calculating KE. I'm not sure if we are together. Florence, Topista, and Milka.
Dennis, I told you this topic. You will never hear me talking until you finish up with this topic. I'll be talking. This topic, no.
It's that simple. You only have three formulas. Winnie, do you remember this formula that we used? Nakumbuka hii? Na tena unakumbuka hii? Alafu today tuko na the third one. Those three. Now when examiner sets the question and you need to get KE, you ask for yourself, uko na nini kwa mkono? Ni kama Moses aliulizwa, what do you have in your hands, right? So again, you want to calculate KE, you need to ask yourself, what do I have? What you have should tell you the formula to use. Kama umepewa dividend na umepewa the price of the share, then definitely that is telling you.
I have a question.
Ukiona umepewa E, earning and debt or whatever, then they are not talking about dividends. They are telling you use this one.
Excuse me, Mali. Yeah. Now, when and where do we apply this last formula of KL is equals to KU?
I'm coming there.
Plus KU minus.
I'm coming there, really. That is the next step. We're going to do it right away. So I was just trying to emphasize that there are three formulas that we have learned so far for calculating the KE. So it depends on the information that is available. Where you don't have dividend winning, kama hujapewa dividend, haujapewa growth, achana na hiyo. Ukiona the same question has not given you earning before interest and tax, it has not given you interest or debt, achana na hiyo. Angalia kama hiyo question sasa iko na debt equity ratio. Ukiona umepewa debt equity ratio na pia umepea the cost of unlevered fund, that is the only thing that you have. You know that the third formula is now applicable. So you are forgetting about this, you are forgetting about this, you now think about the third formula because you've been given debt equity ratio. And they might not say that there is debt equity ratio. They can tell you that the value of debt was this, the value of equity was this. They are not mentioning about anything to do with earnings. They are telling you that those values of debt can give you the debt equity ratio. Kwa hivyo saa hiyo sasa unatumia akili, sijaona income, sijaona earnings, sijaona dividend. What am I seeing? I'm only seeing the value of debt and the value of equity. So they are telling me I can use debt equity ratio formula, which is the third one you're talking about. We want to prove that whenever you have now the two informations available, kuna hii information iko available, na ile ingine pia, debt equity ratio pia iko available, can you still get the cost of equity to be the same thing? We want to prove that. That's where we are. So that is for levered or unlevered, the VE. The only difference here, the value of equity, if you see that the information that you are having, ukona debt, then this one now refers to the value of equity of levered firm. Kama una debt, meaning that interest will be zero, the value of equity that you'll get, or the cost of equity that you'll get, it's for unlevered firm sasa. So the only thing that will tell you whether it is VEL or VEU is whether you have seen the debt somewhere. If the debt is zero, then whether you are calculating the KEU, so whether you're getting the cost of equity or the value of equity, if debt is zero, just know that it is for unlevered firm. Tunaelewana wini? The formula is the same. The only question is, are you able to see the debt? If you're going to use the debt, now useme hii debt ni 8%. 8% interest yake ni this amount. Unachukua hiyo interest unaleta hapa. Hapo sasa the value that you'll get is the value of equity of unlevered firm. And even if you have to calculate the cost, it is cost of equity of levered firm. Not unlevered, but levered, sorry. Levered, because you have involved the debt element. Lakini kama debt ni zero, then is either cost of unlevered or value of unlevered. The formula remains the same. So let's proceed and prove this one. So now that we are going to calculate, we want to test whether this formula and the third one are basically the same. The third one is the one that we've been given today. That is under proportion 2, proportion 2. So we have our interest. We can calculate interest. So interest is 8% of 5 million. That is, what is it? 8% of 5 million is it 400,000? Confirm. So that our KEL is equal to EBIT, which is 1 million, minus 400,000 into 1 minus T, which is now 0.7. All these over the value of equity. Now, because we have used debt, this one must be value of equity of levered firm, because we have used debt to get the interest. So the value of equity of levered firm is equal 3.5 M. Simple. Get me this. So it is like 3,500. Now you can calculate and get me the answer. Get me the answer. That will be the KEL. We want to test if it is true that they are the same with that third formula or third method that we are talking about. So we call it method 2. Which is the third formula. So it was saying that KEL is equal to KEU plus, in bracket, KEU minus KE into D all over E into 1 minus T. You are getting the answer to be 20 point, for sure. 20.57. Somebody else? Mi naona hii minus hii ni 600. 600 times 0.7, that should come to be around 4,200. So that is 4.3. 4.3.
I have a question.
Yes.
Before you complete. This 1 minus t, is it for the interest or for everything? Because me, I've used it for the interest only.
Because first, when you're getting earning after tax, you first minus, take the earning minus interest. Alafu ile answer unapata ndio sasa una tax. Inakuwa hivi.
Oh, nimeona sasa that 20 is wrong.
Yeah, so here is 12%. Earning after tax is EBIT. You minus interest first, which is this. The answer that utabaki nayo, which is 600, you multiply into tax, or you tax it now. So you're supposed to get 12. So let's prove that here. If you're going to get 12 on the same situation, 12, right? So let's try with this one. So our KU, we are given us KU unit, cost of unlevered farm is 10. Still, from the information that you have, the cost of equity of unlevered farm was 10%. So we are having here 10, which is 0.1, plus in bracket 0.1 minus the cost of debt. Cost of debt tunapata ni ngapi? We are given us KD ni 0.08, which is 8%. The 8%. And then debt equity, that is 500. Now 5M over 3.5 M into 0.7. So what do we have? 0.1 plus, this one is giving you 0.1 minus 0.08. Let me calculate. Zero point 1 minus 0.8, 0.02. So we are going to have this, these ones are giving us 0.02 into 5 all over 3 times 0.7. Hebu mniambie mnapata ngapi hapa? Is it the same? Because we are saying that whenever you're given information that can give you all this that you want and all this, then whether you use this formula or this one, the answer should be the same. You are saying that they are the same, 12%. So hapo tumeconfirm kwa sawa. So you can use either. You can use either. Now I want to give you a disclaimer. I want to give you a disclaimer where the EBIT are different. When you're comparing two companies with different EBIT, then the best formula to use is this one. EBIT that we have used is 1M for each. Sindio? Okay, realize that the EBIT that we're using are different. Don't use this formula because you're going to pick EBIT that differs. The EBIT here are different. So ignore the formula that goes with EBIT. Use this formula that is neutral, which has nothing to do with EBIT. And you can put that note that where earning before interest and tax are different for the two companies, use method 2. The examiner can give you a situation where the earnings are different. Apply method 2. So we can now calculate our work. If they're the same, if EBIT are the same, you use any of them. If they're different, use method 2, this one. And I can't emphasize enough on that. So let's now proceed. We can now calculate our work. So we have 0.41 times 12% plus 0.59 times KD was 8% into 0.7. Get me the answer. What is work? That is for liver farm. For unlivered farm, we agreed that if it is unlivered, then work is the same as KE of unlivered farm, which is 10%. So you don't need to calculate. Unasema tu hivyo. Because the cost of equity of unlivered farm is the cost for all that funded that business. Is the cost of the capital, which is the same as now the work. So get me the value of work for livered farm. What are we getting? Eight point 8.1. 8.1%. 8.1%. We still have time. We can do one
Dennis,
more example.
Dennis.
Yes.
See the KE, the illustration that you gave out earlier, you said KE for the both livered and unlivered farm was 10%. So I'm wondering why you calculating another KE, but initially you gave out to be 10% each.
Yeah, that is a good observation. So what they were giving you was not work, it is the KE for the equity in the market. If that equity, it is just the normal cost of equity in the market when you are buying purely equity, and the cost of shares, of gaining shares in the market. They have not mixed, they have not brought the structure. You know, when you mix them, now the cost of shares changes because the ordinary shareholders wataona some risk. Sijui kama unaelewa. Wakati umeenda kwa market unauliza what is the cost of the shares? Utaambiwa it is 10%. That is, you can decide to finance your company with shares purely. It will be the normal cost of shares. That is what you have. Lakini wakati directors wameanza kuona that now you are also bringing some debts in the business, so it is becoming levered, wanaanza to change mind. So whenever you now mix them, you now need to calculate a new cost of equity of a levered farm. So what we're saying is that whenever you're given such information, the KE of levered farm that you're given there, ignore it. Ignore it, calculate afresh a new KE of levered farm using the formulas that I've given you, the three of them. You always ignore. The one for levered farm, that is just okay, because they're giving you the one that is trading in the market. But now immediately unaanza kuongeza debt in the structure, hapo sasa wanaanza kuogopa kidogo. So you need to calculate your new KE because of the risk element. So, and I'm sure you have realized that when you don't have debt, KE was 10%. Immediately you bring debt, it is becoming 12%. Why? It becomes now expensive. These guys are having 2% premium to take care of the risk because wameona umeanza kucheza vibaya, unachukua deni mingi. So the debt, the cost of equity becomes expensive. In fact, ukiendelea kuchukua more debt, it becomes more expensive because they are seeing higher risk. So it becomes more expensive than you thought. And that is why in that second formula, they are giving you D all over E. They are telling you how much debt are you taking instead of equity. So the more the debt, the more the KE of livered farms becomes expensive, or the more expensive it becomes. So that is why in the second formula, it considers the debt equity ratio. Yani how much debt are you bringing in this kind of business? And so the more the debt, the higher the cost of equity of the livered farm. So it will have to vary. Directors wanaogopa or shareholders wanaogopa. So I'm repeating that whenever you're given such kind of information, ignore that the cost of debt that you're given under livered farm. For livered, pick it, that is the correct one, because there is no risk element. For livered farm, ignore the one that you are provided with there. Calculate your own afresh using the 3 formulas, whatever is favorable for you at that time. Let's look at illustration 2, where now we have different EBIT. In this one I did, we were having the same EBIT, and the EBIT was basically 1 million. So what about if the EBIT varies? What will be the implication? So let's have the 2 farms, that is a livered farm and unlivered farm, and then we have EBIT, or they call it sometimes operating profit. Kina wamesema operating profit, usianze kushangaa ati mbona hii wana mention operation na mimi nimezoea EBIT. They are the same. So have EBIT here, then here we have 2M. Here we have 25 and 2.5. So you can notice that the EBIT are not the same. Therefore, the formula 1 will not be the best. But let's just proceed. So the KE is given here. So this one sometimes they don't even give you because it is irrelevant. I told you that you can even ignore it. KE that you're given in the question, you need to calculate your own. Ile umeona hapa, the examiner can decide to give you the one that is prevailing in the market, or they can even leave it blank. Haina effect, ignore it, assume that you're not given. Hata kama umepewa. Now in this illustration, the examiner has decided to save you by not giving you that. So you only have this one, which is okay. Hii iko sawa. Hii hata wangeweka hapa, you should ignore it. So hapo amejaribu. Then we have tax. Tax is given us. Tax is 40%. And then here also 40%. And then we have 7.5 debt. This is the KD. Sasa. KD. Then we have 4 million. And then we have, of course, here we don't have debt. Still. Yeah, in a livered farm, I never debt. Debt is only applicable in livered farm. Required, calculate the value of each farm using MM2 and work using MM2. So sometimes examiner can be very good. They can tell you to use MM2 or they just say calculate. Wakisema to calculate, what should guide you? Inafaa ujue kwamba MM1 does not have taxes. But because in the question we have taxes, that is definitely MM2. The fact that they have taxes, now you need to stop thinking about MM1, a world without taxes. Think about MM2, world with taxes, because you have seen taxes. So the examiner can mention, use MM2, or can just be silent. Unatumia akili. So calculate the value of each farm using MM2 and work using MM2. Calculate the value of each farm and work using MM2. Calculate the value of each farm using MM2. Calculate the value of each farm using MM2. So where do we start from? We are saying that according to MM2, the value of livered farm is equal to the value of unlivered farm plus debt tax share. That is what we have seen. We also learned that the KE, you can also get it through KEU plus in bracket KEU minus KD into that all over E into 1 minus T. This formula, when I was doing a time, I didn't like it because I couldn't cram it. I couldn't master it. But I realized that it is the best one that I need to understand. I can tell you, try to master this formula. So that is where we are. We have to calculate the value of each farm, and then we have to calculate the work. So the value of unlevered farm, as usual, we can say solution. Value of unlevered farm, we say that it is the EBIT, which we have, minus interest, which we know is 0. All this you tax. When you tax the all of it, and then you have the KE. Of course, it is KE of unlevered farm. So we are having here our EBIT, which is we are now working on unlevered farm. We are working on unlevered farm. So our EBIT on unlevered farm is, so when you have two EBITs, remember you are using, you are calculating the value of unlevered farm. So use the EBIT of unlevered farm. So you have 25 minus interest is 0. So all this 0.3, 0.6. Use the tax that the examiner has given you. Don't use the tax that you know is applicable in Kenya. Kenya it is 30%. Actually, they increase it now to maximum 35. Lakini for exam, tumia yenye umepewa. It can be 35, it can be 30, 25, 40. So we are using that. And then KEU, we are given as 0.1. Can you give me the value of unlevered farm there? What is the value of unlevered farm? Let's work as a team. Tufanya haraka haraka kama team moja. You're getting 15 million. Eh? How many people are getting 15 million? How many of us? How many of us are getting 15 million? Is it the correct one? 15 million. Thank you, Stopista. Now, we need now to get our value of levered farm. And the value of levered farm, you know, the value of levered farm, we know that is now the value of a levered farm plus debt times tax. So we are saying that the value of levered farm is equal to the value of levered farm, which is now 15M, plus debt here, the value of unlevered farm, VU, plus debt, which is 4 times tax, which is 40%. This one is giving us 15 plus 1.6, if I'm not wrong. So that we have 16.6 nil. 16.6. We are done with the values of the two farms. We have calculated the value of a levered farm. We have calculated the value of levered farm. So kama ni mtihani, you are done with the first part of the question. You now need to calculate work. So work, as usual, you know what we use. So that we have the weight. So let's start with the weight of the weight of equity. we said that weight of equity is equal to value of delivered farm, value of delivered farm minus debt, which you can get. The value of delivered farm is 16.6 minus debt is 4 M. So that gives us 12.6 million, right? Therefore, our WE, this one is the equity. So WE is equal to equity all over BL, which is 12.6 all over 16.6. I don't know what answer you're getting. I'm getting 0.76. So that means that our weight of debt is equal to 1 minus weight of equity, which is 1 minus 0.76. I don't know if you're going to have 0.24. Tuko pamoja? So we are done with the weights. Florence, this one is just the same as weight of debt, which is equal to debt all over BL, which is debt, 4 all over 16.6. Try if it is this one. To avoid repetition, I'm just trying to do that. Let's now come to our K, cost of equity. At least cost of debt we know. So cost of equity, we said there are two formulas, and we want to try the first one that we know, that is EBIT minus interest into 0.7 or lower. But now it's cost of equity of delivered farm, because we are looking at the work of delivered farm. You have to find average to weight. So this farm is delivered. So even the cost of equity should be for the delivered farm. So it is all over the value of equity of delivered farm. We can be able to try this. So you need to go to EBIT of delivered farm. The EBIT of delivered farm is how much? From the question that we have, it is 2 million still. So we have 2 million EBIT of delivered farm minus interest. It is 7.5 times 4, still 4 million. Whatever you're getting here, you're going to multiply with 0.7. Lower cost of equity here was 12 point. So try for me. What do you get? 7.5 or 4 million? Oh, sorry, thank you. So here should be 6. Thank you. So 7.5%, 0.6. Should be 7.5%. So we have 300,000. So we're having 2 million minus 300,000. What do you get? That is a 700. This one is 1.7 times 0.6. $10.20. So we are having there 10, 20, all over 12.6. What do you get? In a million. So we can put it in millions. So that is total 600. Winnie, what are you getting? So pesa umeweka ikiwa full 12 million, 12.6. Not just 12, but 12.6. Because this one is million. Remember the figure were in millions. Try again. You're getting 8.1. So we are trying to use this formula so that we can be able to see that is it true that these formulas cannot give you the same figure in case the EBITs are different. Whenever EBITs are different, you will not get the same figure. So you choose the one that I told you. So let's use the other formula that you know. That formula number 2, or we call it method 2. So call this one method 1. So that we come to method 2. The 10%. We were given 10%. Thank you. That was that is 4. So we have 4 all over 12.6 into 0.6. So we have 0.1. 0.1 minus 0.07. 0.025. So 0.025 times 4 divided by 12.6. The answer that I'm getting, multiply with 0.6 plus 0.1. I'm getting 0.10476. 10476. This one is like how many? 10.5%. Is that what you're getting? Or we can have it 10.8 point. But it is the same. To go sour. So please separate first, calculate this. Multiply, the answer that you're going to get here is 0.025. Multiply with 4 divided by 12.6. Then multiply with 6. After getting those answers from this side, we now add 0.1. Thank you. You're getting 10.48. Now you're okay. Now you can see that when you use this formula, we're getting 10.48. When you use the other one, we're getting 8.1. So they are not the same like the previous one that we did, which was giving us 12 in both cases. When we have different EBITs, then the two formulas are not the same. So always choose formula number 2. Therefore, we are saying you can write and say method 2 is preferred where EBIT for unlevered farm is different from that of levered farm. Method 2 is preferred. Method 2 is preferred. Method 2 is preferred where EBITs for levered farm are different from EBITs for unlevered farm. So let's calculate work. So we pick the one for method 2. So therefore our work is equal to the weight, which was 0. What did we calculate? The weight was 0.76 times 10.48 plus
Dennis,
0.24 times 7.5 times or into 0.6. Yes, Florence?
then
Yes.
I have a question. So when calculating work of levered farmer,
Come
what
again,
are you
sorry?
I'm asking when always you've used a method 1 in method 2, are you proving that you want to get KE for unlevered to be 10, or what are you trying to prove? Because the first one we've gotten to be 8.1%. This other one, it is 10.48. What are you trying to prove in between here? That is what I'm not understanding.
We are trying to calculate KE using the two formulas to check if they're the same, like we did for the first one. But then we realize that it is not the same. And the reason why they are not the same is because we have different EBITs. So we are saying that whenever you have different EBITs and you want to decide on which formula to use, always go for the second method. Achana na hiyo method ya kwanza. Ruth is saying, what time is class ending? We started at 8 and the class is 2 hours. Umechoka mapema. So let's calculate work. Get me the value of work. Ruth, umechoka mapema, tumeanza 8 na unalia. Hii syllabus ni refu. Hata 2 hours hatujamaliza. Tangu tuanze class. Lesson is normally 2 hours. 0.9. Sorry, we have 9.4%. Thank you. Now, I want us now to look at a question here, which I shared on WhatsApp. Look at your WhatsApp. We are not going to do MM3 today. Or should we? No, we are not going to do it today. I want us to look at that question that I shared on WhatsApp. It's a very simple one, then we can go and sleep. Have you guys confirmed that work is the way we have gotten it? 9.04? That question that I shared, it is for December 2011, question number 1B. December 2011, question number 1B. The question says that Motor Limited is considering whether to buy a certain machine. Motor Limited is considering to buy a certain machine costing 10. Does this one has capital structure? Oh, we have a capital structure here. So in this question, they are combining the knowledge of, they are including the knowledge of capital budgeting and that of, they are mixing some elements of topic 3 and topic 1. So when you look at that question, it is talking about the machine. So the machine is costing 100 million. So they are considering whether to buy the machine at the cost of 100 million or to lease the machine. It is estimated that the machine will reduce variable cost by 31 million. So that reduction in variable cost, that is the advantage, or it is the benefit or profit. So in some cases, when they are setting questions, they will not tell you that there is going to be a profit of this or a sale of this. They're telling you there will be a reduction in cost, or they tell you there will be an increase in income. Such kind of terms are going to give you what you should use as the profit. Sawa. Kwa hivyo usianze kutafuta ati mbona sijaona profit hapa, mbona sijaona. They are trying to use such terms to help you know. So Motor Limited is considering whether to buy a certain machine costing 100 million or to lease the machine. It is estimated that the machine will reduce variable cost by 31 when they have the machine per annum, 31 million per annum. The machine will have an 8-year life with no salvage value. With no salvage value. The machine will be depreciated on a straight line basis. The company's optimal capital structure is 50% debt. When you are told 50% debt, that means that equity is taking the other 50%. So we know that the capital structure is normally a debt plus equity. If you are told that it's 50% debt, then that means that the other one is also 50%, so that we have the total value of the firm, which is now 1 or 100%. So that basically, they are telling you the proportion or the ratio of debt in the firm, the proportion of debt in the firm. It's before tax cost of debt and cost of equity are given as follows, 15 and 25 respectively. So we have the KE before tax, which is 25%, and then cost of debt, KE is given as 15%. All right. The corporate tax rate is 30%. So whenever you see the corporate tax rate, then you know this one cannot be MM1 or NOI. It has to be MM2. That is what you can apply where the taxes. So tax is 30%. If the company were to lease the machine, the fees will be 21 million. That is an expense or cost. If they're going to lease the machine, they're going to pay a cost of 21.4 million per annum at the end of each year. Assume that the lease is a finance lease. The net present value required, calculate the net present value if the firm decides to buy the machine. Also, you can calculate the NPV. You have to calculate the NPV if they decide to lease the machine. Then you can advise the management on what to do. Now we know, for you to calculate the NPV, then there are things that you need to know. Remember what you need to have for you to calculate NPV. So NPV is equal to the cash flow times PV per, because we are told per annum. PV per a certain rate, percentage, minus IO. That is how you calculate NPV. Sindio? Do we have cash flow? You need to calculate. Do you have the PV per? You need to know the period. You need to know the period and rate. The period and rate. The period you know. Sindio? Umeambiwa? The machine will have an 8-year life with no salvage value. So you know the period. And then you're told that the machine will be depreciated on a straight line basis. We have to use depreciation. Why? Because tax is there. Florence, when tax is given, depreciation becomes relevant. Not irrelevant. So it becomes relevant. So that means examiner has given you the tax and has mentioned something about depreciation. You need now to consider depreciation as you come to the cash flow. So let's look at how we can be able to calculate the two. So we need R, which is not given. They have not told us the cost of capital. Now, the cost of capital that is applicable in a situation where we have capital structure that has got both debt and equity. We have to get weighted average cost of capital because the cost of capital, this company is financed by both debt and equity. So if it is equity only, they could have given you the cost of capital that is direct. This one they are telling you, can you calculate work? You use that work to discount. Use the work to discount. So you can write NB, use work to discount. Use work to discount cash flows. NB, use work to discount cash flow. Now, we need to calculate work so that we can proceed and know. Because already we know this one is a levered farm, and that is why we have percentage of debt and then percentage of equity. So let's calculate work. We know that work, you can say a solution. Work, we know that it is like that. So that we have the weight, all right? Weight we have, we are given already. Weight we are given already. So what we don't have is the KE, the cost of equity of levered farm. The cost of equity of levered farm in this case, how do we calculate it? Can somebody tell us how to calculate the cost of equity of a levered farm?
The cost of equity of unlevered farm, it is the same. It is 25%.
Yeah.
The cost of equity work for unlevered farm, it is the same. It is 25%.
Good. So you are given already 25%. And then you are also given the KD, which is 15%. Those ones you've been given. They are given you. Now, we now need to know the cash flow. No, from here we can calculate our work now. So the work will be weight, which is 0.5 times 0.25 plus weight 0.5 times 0.115 into tax is given 0.7 still. So what do you get as work? What do you get? Seventeen point 75. Can even call it 18%, but we have 17.75%. Thank you. So we have our R. Just round it off to 18% for easier discounting. If you can discount it like that, fine. Or you round off. Now the next part is now to calculate the cash flow. We are told to calculate NPV of the farm if they decide to buy the machine. So the cash flow will be different if they buy and when they lease. So let's look at buying. Cash flow when buying or for buying machine. how do we say cash flow on, doesn't matter here, English doesn't matter, they know what you mean. So our cash inflow, which we know, that is a benefit which we call profit, the cash inflow is 31. We are told how much? 31,000. 31 million. So let's have them in thousands. So we have this in thousands. Then after that, if we buy the machine, we are not going to have the cost. Like now in leasing, we are told that if we lease, the fees will be 21. That is a leasing fee every year. When we buy, there is no additional cost except depreciation. So we have less depreciation. This is the benefit that we get when we have the machine. Now you remove depreciation from that benefit, which you now say depreciation is how much? You can calculate depreciation upper. Assuming that we buy the machine we are supposed to buy at 1 million or 100 million or lower 8 years. How much is it? Depreciation? 12,500. 12,500. So when you subtract that, what do you get? This one is going to be 500. Here to be back in at 8, and here to be back in at 2. I think so, or is it 1 or 2? 1. It's 1. Thank you. So this one is there. Profit before tax. Now let's tax. Tax we thought 30%. 30% of this ingati. 30% of that. $5,550. So minus. What do you get? Profit after tax. You could have used the other formula of inflation tax shield, which you can try.
Excuse me, Walimu. In depreciation, I think it should be 125, not 12,500, because we had carried the 3 zeros. 1 million to divide by 8 is 125,000. So it is 125. Oh, it was 100,000.
Oh, 1 million, 100 million.
Okay, so it was 100 million, sorry.
Okay. Now, 100 million, now have it as 100,000. 100,000 divided by 8 is 12,500. Confirm.
You are right.
Confirm. This one is 12,500.
Yeah, it's okay. It's correct.
So let's proceed. Florence, we have not even taken our 2 hours, so you can get the video tomorrow. So feel free, you can get the video tomorrow. So we are having there. Hello? 950. So that is after tax. 950. Then now add back depreciation. depreciation when we add back to 500. So we're going to have for 50, then we have 25 for 50. Is that what you're getting? 25 for 50? So that is the income when we decide to buy the machine. So if we have that, then we can now get our NPV here. So you have 25 for 50 times. We now have the rate 18%, 8 years. What is PV? We now have 18%, 8 years. What do you get? 3 point. 18%, 5 years, 3 point. It's 4 point, not 3 point. So it is 4.0776. 4.0776 minus IO, which was 100 million. So that is going to give you the NPV. Let's now look at the last part and then we close. So get me the NPV there. If we decided to lease the machine, if you lease the machine, then you are not going now to calculate the depreciation. So you're going to pay the cost of leasing, which is less cost of leasing. The cost of leasing they have given us 21,400. So we have to, when leasing the machine. So we have 21,400. 21,400, what will be the profit? Here you have 377,492. That is NPV. Okay, so let's calculate if you lease the machine. You are going to have the inflow minus the cost of leasing. Now you don't depreciate because you don't own the machine. So just lease and pay the cost of leasing, which is 421. We are getting here 9,600. So 9,600 there. Profit before tax. 9,600 now you can tax at 30%. So now this one 30%. It's giving you 2,880. So 9,600 minus 2,880. You're going to have profit after tax, which is 6,720. So profit after tax, which is 6,720. That is our we have depreciation. That will be our cash flow because we don't have depreciation. We don't have depreciation. This is a cash flow. So our new NPV when you lease.
Excuse me. Why don't we have depreciation and yet the machine is being used? So I think it is depreciating.
No, the first option was when you buy the machine, you are allowed to depreciate because you own the asset. In the second scenario, ni kama you just borrowed it, you're just using it and you pay installment, or you pay the cost every month or every year. Sasa the cost of leasing. Kwa hivyo you don't own the machine. Unatumia machine ya mtu, unamlipa yearly. Yeye ana recognize whatever you're paying him, ana recognize kama income na ana depreciate on his life, on his side. So ni kama umerent. Sasa, so when you rent, the only cost that you are incurring is the rental cost, which is now the leasing cost and not the possession. You don't own the machine. Amount of differences.
Yes.
Yeah, so that is why now we're having this one. So we are saying now this one was combined. our NPV, we have seen. Now on listing here, we're going to have NPV, which is now the cash flow is 720 times PV far. PV far we are having the same 4.0776 minus, what are we minusing? How much is the cost IO? Are we given IO? Do we have IO? We didn't have the machine, so the IO is 0. Still, we didn't own the machine, so there was no initial cost of buying the machine. However, the initial cost of buying machine here is 0. We didn't incur cost of buying machine. When we list it, there is no cost of buying machine. So whatever answer they are going to get here is the NPV. So what is the value? Okay, 7,401.472. So those are the NPVs in those respective situations. Those are the NPVs in those respective situations. What can you advise now? Winnie, what advice can you give? They told you calculate NPV, which you've done. Then advice. Can they lease or they buy? We are done. Even before time, we are 20 minutes early. Ruth is saying buy. Ruth, if you buy, the NPV is 3,774. If we lease, is 27. So here we have higher NPV than this. However, the best option is to lease because we need to have a higher NPV. This is the kind of question that can always be brought where they mix some knowledge in topic 3 and also in topic 1. Lease the machine because it has the higher NPV. That is the explanation. Lease the machine because it has the highest NPV, the highest positive NPV. Thank you so much. Tumemaliza mapema as I expected. So we shall pick, we still have MM3 and MM4. Those ones are quite wide. And MM4 is always examinable. So make sure that you attend the next class, MM3 and MM4. Have a good evening. Tukimaliza hiyo, I think now we are in the right track. It will be easier now. We have few lessons to talk to finish topic number 3. Topic 3. Then we go to topic 4, 5. Then we come back to revision. Any question as I close? Good night to Pista. Florence, umechoka sana. Ruth, you can now go and sleep. Pole. Waziri alisema this time, ongei this time. Sir, thank you. Edwin, ume left na bado uko meeting. I don't understand. Or did you come back? Oh, you came back. Ruth ndiye ame left sasa. Sawa. Thanks. Milka, bye. Have a good night.
Excuse me, Malim, before you go.
Mm-hmm.
Can we do that question for this 17 minutes remaining? The one I've posted in the group. For those
I've
who
seen
can
the
manage.
question, but nimeona watu wamelia, wamechoka. I don't know what to do. Switch here.
I don't even know the year.
In a study carried out, let me just read it, but we won't do it now because of people are exhausted. In a study carried out by a financial analyst, the earnings, that is earning before interest and tax for Papa Limited and the Kaka Limited, is 10. Those are two. We have the debt trading at par. Both firms adopt a 10% payout ratio as the dividend policy. The cost of equity is given as a 10%. So which MM is this? In MM?
MM1 without taxes.
Thank you. There is no taxes. And then just like NI, they are saying that there is a 100% payout. Using Modigliani and Miller's proposition in the absence of taxes, hata wamesema hivyo, determine the cost of equity of Kaka Limited. The first one unaweza jaribu, sio? You can try and share. Comment on the equilibrium position on the value of both firms and hence show that the capital structure decision will have no effect on both value of the firm and the weighted average cost of capital. That is MM1 value. So number 3, calculate the immediate profit, if any, for shareholders on earning 10% of the shares of Kaka Limited. Let's do this in our next class when people are fresh so that they can be able to understand. But the first part, I'm sure you can try that. So we shall do it in our next class. Have a good night.